Per usual, everything on this channel is for educational purposes only. It is not intended as financial advice. We have a wide-ranging video today. Where else are you going to hear about the Fed, Rolexes, Magic the Gathering, housing, etc.? Let's start with inflation. It's Macro Monday. Inflation in the US continues to optimistically, I'll say, hold at lows. One of the things I'll get to later is are all the macro people doomers? Because that's what it seems like. Everybody's a doomer. I don't know if it's a political thing. I don't know if they want a regime change, or is it just okay to be a doomer? I'm not saying we're not in doomer times, but the data here, as we'll see in a second, is certainly leaning more doomer. It doesn't pay to be a doomer over the long term. But the problem with inflation here that people are starting to notice is, if we've leveled off truly, this is real-time estimate. Next CPI isn't for a couple of weeks, but the problem here is if we've leveled off and we're not continuing our descent towards that 2% target, does that mean the Fed is going to have to keep hiking? Does that mean CPI is going to increase maybe regardless of what the rates are? How high can the Fed realistically take rates? We'll see what happens on Wednesday when Powell will be asked those questions, and we'll see whether or not he answers them, whether or not he alludes to another hike a couple months from now when the next meeting is, but almost certainly there will be a 25 basis point hike on Wednesday. Based on probabilities, it's not an almost, it's a certainty. So they are unlikely to surprise the markets and not bring on that 25 basis point hike. We're starting to see commodities pick up a little bit. Now, the decline of commodities certainly helped CPI inflation come down. I'll talk about oil in a second. It's up a bit over the past week. So I really hope for all of our sakes that this is not a nadir in CPI inflation, and we're going to see this cycle where everything starts to grind higher. Here's what inflation looks like in the G7 countries. UK still has a ways to go, and based on the Truflation data, they have it at 11.5 still. So in this case, Truflation's much higher than the country's reported inflation picture. Certainly important for just the global conversation, but also when we're talking about things like DXY, relative currency strength, that sort of thing. Are we hiking into recession globally is the also overarching question here that everybody keeps asking. And that remains a very real possibility. This is the other issue that people keep bringing up with inflation. It's probably better to look at this in comparison to rates and how rates came up or down during this period. Important probably to look at what oil was doing during this period. This is from Tavi Costa on Twitter, Crescat Capital. To me, he seems very pro-metals, very pro-doomer side of things. I'm not saying he's wrong. It's just, people present specific data points more often than not when they have a bias or a worldview. And that's okay, but you just have to know what you're looking at and who it's from. So this would probably be worst case scenario where we just have continued waves of inflation. I'm talking risk assets, right? At the end of the day, I care about this stuff because of how it affects crypto and Bitcoin. So if inflation keeps raging, cost of living is out of control, Fed keeps hiking, Fed's hiking us into oblivion eventually, Fed's hiking the debt load into oblivion. This is just not a picture that we want to paint, not a road we want to go down. As far as probabilities go, 100% chance effectively at a hike, like I said. Now there's no meeting in August, and there's a lot of time in between now and September. So we'll see what September brings, but lest we not forget that the meme, "Wake me up when September ends," stolen of course from Green Day, is very true with Bitcoin. Historically, September has just been not a great time. So we'll see how this pans out. If we get another hike, that's going to continue to affect banks, mortgages, car loans. Not saying it's not needed. What are we fighting here? Are we fighting inflation? Are we trying to prevent multiple waves of inflation? Are we trying to prevent a recession? Are we acknowledging the fact that recession is possible? Or is everything just hunky-dory, totally fine? I don't know. Those are the things we're wrestling with here. DXY, though, mega massive bounce from that very explosive downside drop. This also hurting crypto in the near term, especially if we're consolidating in a very tight range and we're seeing relative strength from the DXY that's going to push Bitcoin, ETH, alts, more likely than not, eventually lower. And that's, what we're starting to see. We haven't yet really seen lows in S&P, NASDAQ, tech stocks, not yet. So that in the back of my head is very much a real concern if we start to magically recouple on the downside, on the crypto side of things, which is typically what you do in any bearish moves. You typically recouple. Look at COVID, right? That's a classic example. Everything dropped regardless of what it was during that period of time. So I'm not expecting flash crashes, but certainly market weakness broadly. Another Tavi chart, again, as many people have pointed out, rising cost of debt relative to what the Fed is actually doing and how sustainable is this. This was something from Treasury themselves talking about the debt held by the public generously and gingerly continuing to increase versus this drawn-in parabolic, maybe more likely scenario. In any case here, this is not sustainable in the long term. You'd think, right? As Lynn Alden says, you don't default because, as other people have said, we have the printer. We can do whatever we want. But it is a form of soft default if we're just printing ourselves into oblivion. And that's where the hard money folks come in. That's where Bitcoin comes in. That's where having a limited supply in 21 million comes in. And that's where at one point, eventually, you think the MMTers are going to lose this argument because the devaluation of printing into oblivion is eventually going to catch up with us. The balance sheet overall, though, on the Fed side of things has come down even lower than the BTFP spike, as Liz Ann Saunders points out. And as Urian Timmer is talking about here, there's definitely a divergence in overall liquidity, U.S. liquidity, versus what we're seeing in markets, right? Now, maybe Bitcoin is a more apt representation of liquidity relative to price versus what the S&P has done, NASDAQ, right? That certainly hasn't been based on valuations. It hasn't been based on liquidity by the looks of it either, even though historically we've really held in line with liquidity. So this to me is another warning sign in general, back of my head, that, hey, liquidity is not correlating with prices here and assets. And eventually that's probably going to be a problem. So personally, am I leveraging up on the traditional market side of things? Definitely not seeing stuff like this. We also have a rise in bankruptcies, a rise in strikes, a rise in car repossessions. This is the doomer side of things, right? We're seeing strikes and wage disputes to an extremely high degree here, which I'm personally for. I think everybody should have collective bargaining. I'm all for it, but eventually that's going to lead to likely rise in wages, likely rise in prices, right? We're seeing all of as an example, streaming services raise their prices. We're seeing prices all over the place, increasing and holding at those levels. So over the long term, that's not going to help things like inflation when we've got stuff like this going on. This is the bankruptcy filings, game of trades. Big spike recently. And, just in the face of it, this doesn't look like a bullish environment or an environment where things can thrive, right? Something's got to give here eventually. And that's, again, what he's arguing, that this time is not different. Unemployment will eventually rise, and a soft landing just isn't going to happen, right? That's sort of the doomer camp. And things will certainly get interesting if that happens during the election year and how the election plays a role in the decision-making process, both before and after, in the timing of that recession. We've got Bitcoin halving, right? We've got all sorts of stuff in 2024. Very interesting coming up. As for housing, average 30-year mortgage rate at 7%. 53% of homes require 125,000 plus. Okay, it's not like the housing market is booming right now. Only 1% of houses have changed hands so far this year. Everything is coming to a grinding halt. And again, this to me doesn't seem like an environment where broadly things can do well. Now, this is very, very regional. Certain areas are doing extremely well. Certain areas are doing extremely poorly, right? Just depends. But broadly, this credit crunch is hurting, and we're seeing things like Tesla launch 7-year financing in the United States. We're seeing car repossessions, 20,000 per day. This stuff on the face doesn't sound bullish to me. And we're also seeing consumers' savings continue to dwindle. I've seen a version of this chart probably every week for the past year. And finally, we're starting to get to the tail end of this where any pandemic savings, somehow that's a bad thing if people have savings. But any savings we're seeing is essentially been zeroed out down here. And that's having effects on things like the luxury watch market. This is a Rolex index. Just, this chart, would you want to long this chart? Where would you buy this, right? This to me looks like it's headed for just continuous lows. We can zoom way out. We can look at, where it was August, September 2021. We're still not to pre-pandemic levels, right? So if I'm applying TA to this thing, it doesn't look super bullish. Doesn't look like it's attempting to bottom. It looks like people are continuing to sell luxury goods, sell things that they may have purchased in a post-pandemic economy, and now because they can't afford anything or they need the money, right? You're seeing things like this. Certainly fewer people buying Rolexes than selling based on this index, and there are other examples of this. Patrick Boyle hates crypto, okay? He absolutely hates crypto, but that's great, and it's great to get a different perspective from somebody like him. He just put out a video 2 days ago about this as well, and very much tangentially and both adjacently related is stuff like this. This is Alpha Investments' Rudy, who is well known in the Magic the Gathering community as a whale, high roller type dude. Point is here, people are also just, fire sailing their collectibles, and you can see that in the NFT market. If we look at CryptoPunk's price floor, NFTpricefloor.com, not quite hitting lows. This is the USD chart, but certainly doesn't look happy or excited. We can look at the ETH version as well. We're not seeing appreciation here. We're seeing people sell or hold more than they are buying, certainly. And we can look at Bored Apes as well. This is the USD. This is the ETH chart, just continuing lower. USD chart also looks like it's headed for lows. So, I'm not an NFT expert, but we're not seeing a lot of excitement on that front. Ordinals, we're still seeing inscriptions, fees paid way down. And on the marketplace side of things for ordinals, volumes are way down. Transactions definitely down. And then if we look at unique daily users, just continuing, I know this is a small slice of the NFT market broadly, but any excitement about Blur is gone. Any excitement about ordinals looks to be gone. Now people are focused on, hamsters and whatever else, what other junk they're looking at. As we sort of move on to commodities, again, just another data point, rice spiking higher. I saw coffee was moving higher. I saw India was moving forward with an export ban on rice. The Russian wheat treaty, I don't even know what to call it. I can't remember exactly, but that also falling apart. So we're starting to see a rise in food prices, commodity prices again, which certainly won't be good for the inflation picture globally. This is oil now. And if you are an oil bull, you really like what you're seeing here because we're moving through the 2-day cloud. We've got a chart pattern on our side as well, Adam and Eve, which on the legacy side of things tends to have an equal bottom here. But if this actually happens, if we get a bullish cloud breakout and this Adam and Eve measures to like 100, 102, 103, that would certainly be terrible for the inflation picture. It would be terrible for any incumbent who's running for office. We can talk about the SPR getting drained, right? Energy prices up here, oil prices up here, would make things globally very angry, let's just say. So I hope this doesn't happen. But TA likes highs, certainly. Now on to the S&P and whatnot. NDX, SPX, QQQ. S&P still looks, from a TA perspective, overextended, parabolic. I'd watch for, in the coming months, some sort of relaxation of RSI. And if that's coupled with higher prices, that's even more of a danger sign. If you get this curvatured RSI and zero response from price, eventually something's got to give there. So yes, you've got people talking about all-time highs. You've got people talking about money on the sidelines still. But to me, this doesn't look too bullish from a TA perspective up here, whereas it looked very bullish coming out of 2022 and into 2023. It's another TAVI chart, but if we're talking about the VIX, the volatility index, and looking at seasonality, this is doomer fuel if I've ever seen it. The fear index, as it's known, if it rises, then risk assets typically don't perform super well. So even though we've lost that inverse correlation on Bitcoin, we'll get to that in a second, I still wouldn't expect a bullish crypto picture if the VIX starts to rise again. Looking at NASDAQ and QQQ, again, bear divs all over the place here. The Kijuns marked on each chart. But that would be a very reasonable pullback based on the daily cloud. Based on divs, it makes sense. So to me, the least likely move here based on TA is bullish continuation. Gold, flat and unexciting, realistically. You know, this doesn't matter to me until it's above 2,000 and can hold 2,000, much like ETH. Both those assets really just cannot hold on to 2,000. Silver looks interesting as well on the weekly chart. Both with gold and silver move super, super slow, obviously, so you got to keep that in mind. But much like the S&P coming out of 2022, you're continuing to get higher lows on silver, which measures to somewhere in the 30s. Should that play out based on TA. So 26 to 32, very decent setup there for silver. Looking at the big six again, I talked about this yesterday for Setup Sunday, but based on the clouds for all of these, based on where the Kijun sits in the cloud for all of these, this is the 2-day chart, just sort of zoomed out a little bit. Perfectly reasonable for some deep pullbacks here across the board. And, you know, arguably you haven't really seen that for any of these yet this year. And this angle of attack at the price rise on Apple is really something. And it just makes me wonder, how much longer can that sustain, right? Maybe forever, I don't know, but looking at this doesn't make me bullish on that chart as we sit here. Now moving back to crypto for a second, institutional flows basically zero, down slightly. Minor outflows, as James says on the weekly report, and ETH actually seeing some inflows, Bitcoin some outflows, short Bitcoin also seeing outflows. So depending on how you want to think about this, the short Bitcoin outflows may counteract the long Bitcoin outflows, right? Or you could say maybe this was some sort of hedged trade. I don't know, but definitely not seeing the crazy inflows we were seeing prior 4 weeks. Things have certainly quieted down, and obviously price-wise, things have quieted down dramatically. Something else that you should always pay attention to is Bitcoin's price performance or outperformance relative to S&P, because that's what the institutional folks are certainly looking at, as well as NASDAQ. You know, if we're just another NASDAQ stock and we're not outperforming the NASDAQ, that's a problem for inflows. And we've definitely chopped around on both of these charts. Definitely not in the 2017 period, definitely not in the 2020 period where we were just crushing highs on outperformance. So that's also going to hurt inflows in the near term. Looking at correlations to some legacy stuff for Bitcoin, January on the right, July on the left, for the most part, we're losing correlations or have lost correlations. We've sort of held our correlations with MicroStrategy, gained correlation with the miners, lost correlations to gold, lost correlations to S&P, NASDAQ, euro dollar just flat, and the Dixie inverse correlation has recovered considerably, and 10-year still fairly negatively correlated. But in general, across the board, we're still kind of, as he says here, econometrics, uncorrelated. This high degree of correlation with ETH, though, continuously, generally hasn't been bullish for either asset. Usually you want to see some decorrelation here to give you a move higher. This might be hard to see on the video, but this is the Bitcoin and ETH correlations over time in a 90-day period. And really since 2018, we've been highly correlated outside of 2020. And especially for ETH, you definitely want ETH to be decoupled from Bitcoin for ETH to see a broad move higher. You know, if you're thinking about ETH BTC, for example, ETH BTC isn't really going to do anything unless it decouples from Bitcoin. So still quite a high degree of correlation there. BTC against the S&P, you know, everybody was talking about how high this was in 2022. It only got higher and higher and higher. And we have decoupled completely from that entire correlation. If that isn't obvious already, because, you know, S&P making highs and Bitcoin not so much. Bitcoin against DXY, we're losing that inverse correlation over time broadly, uncorrelated. And then against the VIX, we've essentially lost our inverse correlation entirely. So broadly, we've decoupled on the crypto side of things, but I think there's a risk for recoupling to the downside if that starts to happen in legacy. And it's interesting that that lines up with this chart, which is just looking at Bollinger Bands and how tight these are on the weekly. This is the tightest weekly Bollinger Bands we've ever seen, which just means we're not seeing any volatility in the past 20 weeks relative to any other period in time. We've seen very stable prices. Yes, we've held above the 20-week, but Bollinger Bands are telling you with contraction, you get expansion. With continuous contraction, you get violent expansion. So a tell for a move, higher or lower, would be a weekly close below or above this bottom band, this top band. For bullish continuation, you want to see a close above 32. For bearish reversal, you'd want to see a close below 25. I think that's probably where that sits. And we've held above the 20-week moving average since the beginning of the year. But again, if legacy starts to roll over, if Fed hikes keep coming, if we start to see more signs of recession, if cost of living just is unbearable, people need cash, that's generally not a great picture for risk assets. And ETH, same thing. It is the tightest weekly bands for ETH. And really here all I'm looking at is still this ascending triangle. It's got some room for downside, but really what you don't want to see is a lower low below 1575. Especially if that lower low comes in on high volume. That's a really strong reversal signal, invalidation of this pattern signal. And also quietly for triangles, they typically break when 3/4 full, and we're definitely past that point. And there's always a concern that once we start to fill these things in completely, they are less likely to actually play out with the bias that they historically might otherwise have. So things getting murkier here on all fronts, I think. Just the doomer data is taking over. It's taking hold of me, and I've become a doomer in the near term. It's official. That's all for this one. Let me know if you're a doomer in the comments below. Like, dislike, comment, share, subscribe. Happy trading.